What's up everyone, Cyrus here. So, unless you've been living under a rock, you would have probably heard of rolling funds now. In this video, we're going to talk a little bit about the history of where they come from, the problem that they solve from first principles, what are rolling funds, and I'll give my views and my analysis at the end of the video as well. Please note, I do not work for AngelList. I have zero affiliation. This is not a sponsored video. This is just a fan expressing his personal views, not investment advice. Please don't forget, we also have the podcast on all audio streaming platforms, or you can watch it on YouTube. We also have the Rational Letter, a once a month long form essay sent directly to your inbox. After just 5 editions, we have hundreds of subscribers, including seasoned founders, VCs and investment professionals, and we've been overwhelmed with the support, so we really appreciate it. Don't forget to hit the like, bell notification, and subscribe. It really helps us with the algorithm. Hopefully we can bring you more of this. Now, let's get into it. So, some believe that early stage investing is one of the most lucrative forms of investing. The gatekeepers just don't want you to know this, apparently. Fortunately, AngelList to the rescue. So, quick background. AngelList was founded in 2010 by Naval Ravikant and Babak Nivi. The web address is angel.co. It's the world's largest startup community and ecosystem, essentially a one-stop shop. Firstly, you can find startup jobs or hire staff for your startup. Now, it's not just limited to startups, it is tech companies as well, the likes of Uber and any of the tech giants, all the way down to a brand new startup. So it is an ecosystem for startups. Secondly, they also own Product Hunt, a subsidiary that they acquired in 2016. Finally, you can also angel invest in startups or list yourself as an angel, probably where the name comes from, and raise funding to invest in startups. Rolling funds is a term trademarked by AngelList themselves, and it's what they have created. So how exactly have they tried to democratize the investment process? Well, previously, the two things that enabled this were AngelList syndicates and AngelList venture funds. Both of these still operate. AngelList syndicates are private single deal VC funds led by top angels. You can invest as little as 1K in some startups. Essentially, an angel would raise a total of 500K, for example, and that would go into a single startup. That 500K is a collection of investors, including yourself, with a 1K check or larger. So AngelList Venture Funds was the next innovation launched in 2016. It is a platform for emerging venture fund managers. Once you're signed in, it allows you to raise investment from LPs, execute on deals, and manage your portfolio, all from a single platform. AngelList take the overhead out of fund management. It basically allows you to connect with LPs who share your investment preference. So an example of this is Ryan Hoover, who is the founder of Product Hunt, who has now gone on to launch Weekend Fund a few years ago. He uses the AngelList Venture Funds platform to manage Weekend Fund. He's built a great following online over the years, and he's made some great investments too through the Weekend Fund portfolio, all managed through this AngelList Venture Funds platform. AngelList Venture Funds also provides full service fund operations. They have a team of analysts, fund administrators, operations managers, and they essentially handle the whole back end of this. They set up the fund's limited partnership, handle the tax reporting, provide accounting services, and so on. All back office services are available on an ongoing basis for the life of the fund. Essentially, AngelList have spent years fine-tuning the process, and they have all the expertise, the infrastructure. They are regulated. For example, even though they are a US company, they are even authorized and regulated by the Financial Conduct Authority in the UK. The platform is used by some of the most prominent investors in Silicon Valley. Now, before we mention what are rolling funds, we first have to address the problem that they solve. So first, let's look at it from first principles. First principles. Yes, video here made by Iman on first principles in detail. Now, normally when you launch a traditional venture fund, you have an array of costs. Back office costs, legal costs, accounting costs. So normally it'll cost you 100K to 200K USD, charged over 10 years just to get your fund off the ground. So based on the economics, naturally your fund would have to be very large, would need relationships with LPs who are able to invest bigger ticket sizes, and this leads to restricted access for all. AngelList said, hey, how do we compress the cost? Secondly, they noticed in this process the other big friction point was the amount of time leakage. For anyone raising a traditional venture fund, you have to set aside 6 to 18 months just to raise capital. You have to take all the meetings, all the warm intros, and you are not allowed to talk about it publicly because it is not allowed. It's illegal. You have to lock down the fund and you cannot raise for another 2 to 4 years. So all this friction, there's cost, time, energy. There's a good saying in business that if you can save people cost, time, or energy, you've pretty much got a winning formula. In this case, AngelList solved all three. AngelList went to first principles and said, why is it structured this way? Why do you have to lock down the fund? Because it doesn't actually make sense. Your best time to raise any capital is when one of your investments has had a markup and there's a lot of excitement, buzz, and hype around it in the markets. Why can't you just keep raising capital? The traditional venture fund was built in a world where people, human beings, were doing all the back office work, the legal, the accounting, and so on. Rolling funds are a venture fund structure built in a world post-software. Rolling funds are actually a superior structure to traditional venture funds. If software existed when the traditional venture fund structure was created, it would probably be a rolling fund. A rolling fund, if you want, can actually apply constraints and build a traditional fund out of it. It's just a traditional venture fund that has many other features on top of it. And you can choose the features and mix and match the features however you want. At its core, I just see it as a venture fund built through software. Because of that, you don't need all of these constraints. You don't need to lock the fund down and then go and deploy and then raise again and go through this big bang fundraising that they call it. Rather, you can just always keep it open for raising. Because AngelList had all this infrastructure they had built up over time from AngelList syndicates and AngelList venture funds, they were able to execute on this really well, in my opinion. So now you're able to bring a lot more fund managers into the market because you don't need to raise 50 million just to get a fund off the ground because it costs you $1 million to $2 million just to get it off the ground. You could just raise a $1 million fund and not a $50 million fund. Rolling, as the name suggests, as it rolls every quarter. It's an always open venture fund. A fund manager will never need to raise another fund again. Fund managers can now accept capital in the form of auto-renewing quarterly commitments. You can raise funds incrementally, one investor at a time, rather than having to do the traditional big bang one-time fundraise. Hence the name. The fund rolls, it's a quarterly subscription. So rolling fund managers require less capital to start investing. Fund managers can continuously accept new capital commitments, giving them an increasing stream of capital to invest in startups. The subscription nature of capital commitment allows fund managers to do three things: raise a fraction of a traditional venture fund and start investing right away, leverage portfolio markups to accept new capital anytime, continuously increase the fund size so they never need to raise another fund again. Rolling funds have been vetted by the funds group at Wilson Sonsini, a very prominent law firm headquartered in Palo Alto with extensive experience in Silicon Valley, serving clients such as Google, Netflix, Tesla, Hewlett-Packard, and many more. So what does AngelList charge to do this? Well, I'll leave a screenshot here which compares the cost, and it's actually a comparison between AngelList rolling funds, AngelList syndicates, and AngelList venture funds. This is the pricing that AngelList charge general partners, i.e. the person who uses the AngelList platform to launch their fund. AngelList on their website have a FAQ list with many questions covering all the detail around the rolling funds. This is linked in the show notes below that will take you to their website. So let's talk about my analysis. Some consider rolling funds to be like an index fund because where in an index fund you invest in a basket of stocks listed on the stock exchange, similarly in a rolling fund, you're investing in a basket of startups. This is unlike the AngelList syndicates whereby you're investing in only one startup. Now, each rolling fund manager invests in a number of startups, and you can also diversify your diversification by investing in a number of rolling fund managers who then invest in a number of startups. Rolling funds are blind pools. Investors do not know upfront which companies will be invested in, giving fund managers discretion and investment authority. In that regard, they are somewhat similar to SPACs because you're investing in a person who then invests in a company, or in this case, companies. Rolling funds are not evergreen funds. LPs do not gain exposure to earlier investments. Funds raised each quarter count as its own standalone fund. Investors come on for a minimum 1-year commitment and then invest at a quarterly cadence. Some believe that all of this flexibility can come with a cost. The rolling fund structure can be considered somewhat volatile because limited partners have to re-up their investments on a quarterly basis. In a worst case scenario, an LP can drop out on a whim with no repercussion. With traditional funds, LPs are legally obliged to stay through to the end of the fund or just write off their investment entirely. Unlike traditional fund managers, rolling fund managers can actually be public about their fundraising activity due to the SEC regulation 506C. While legal, public solicitation by some of these rolling fund managers has actually rattled some traditional VCs who are used to a ban on marketing their own fund until only after the fund is closed where they can actually announce it. There are rumors that some earlier stage VCs have also been unhappy about all of this because they are seeing an increasing level of competition at some earlier stage investment rounds. Personally, I think this is great. Historically, VC has known to be an elite bubble. There's a great article by Del Johnson on the topic of this bubble. I've linked it in the show notes below. There's some VCs with their rules of I won't travel 10 miles beyond the office and so on and so forth. Now, an underlooked GP can raise money from underserved LPs who can then help invest in underserved founders. Because AngelList views transparency as a core principle, it makes sense that the first rolling funds have been created by a generation of operators and founders who build in public. AngelList's progress over a short time span has been powerful enough to signal to prioritize the new product as a flagship offering. In fact, I can see AngelList becoming a SaaS company. The reason for that being, all of the rolling funds on AngelList's website are essentially AngelList's customers. It charges a fee per customer to handle logistics. However, unlike a traditional SaaS company, AngelList is an LP in a number of rolling funds and makes money the same way a traditional venture fund does as well. To limit unfair advantage, the AngelList team that invests is separate from the team that helps manage and create funds. Despite rolling funds gaining momentum, the structure isn't competing with traditional Series A or Series B firms just yet, right now pre-seed and seed. If you want to invest in a rolling fund, AngelList criteria, the last time I checked, that you have to be an accredited investor. Their definition of this is someone with $200,000 per year income or $300,000 per year joint income in a given household, or I believe $1 million net worth. This is great because those who work in tech, finance, law, medicine, etc., after about 10 years in their career, they're usually earning those kind of salaries, and beyond the typical investing that they do, they may also like to allocate 5 to 10% of their portfolio to speculation. This means that they can now invest in startups, whereas before they couldn't. And that risk of investing in startups is somewhat mitigated by the fact that they are not investing in one startup, but actually a number of startups. Thanks for watching. Let us know your thoughts in the comments. Don't forget, podcast, The Rational Letter, website, you can find both of them. For more videos like this, hit the subscribe button below, like, bell notification, really helps us with the algorithm and allows us to bring you more videos like this. Appreciate it and see you on the next one. Peace.